right. I see Gabriel raising his hand. Gabriel, you go ahead and unmute.
David, how are you? It's good to see you on the
Good to see you,
stage.
Gabriel.
And
Yeah.
Tim, as always, I loved you before, but hearing a little more of your story, it's really cool to hear. So thank you for sharing. On the specific topic of trying to make this better, I did have an operator, a pair of operators present this, and long story short, there are some things that I might put out there that you might want to consider in addition to what you've already considered. But what I'll add for people's context, if I'm not mistaken, David, knowing you pretty much only do fixed rate deals. It's kind of one of the things. Yeah, that is it, right? Yeah. And so that alone, when we talk about downside risk on a deal that's not a heavy value add with bridge execution, that alone changes some of the risk profile, right? So I think that's an important precursor, because otherwise, when bridge goes south, either for a gang of operators because of the market or for an individual set of operators he's been leaning into, that could be very risky to have a lot of exposure all at once. And I think the second point is that it sounds like you're personally, I guess personally is the wrong way to say it, but like in some ways you are forming a pool with some personal exposure such as to make this work, right?
Yeah, I mean, if my math is wrong and more deals go south than I think are going to, I mean, yeah, I'm going to be in trouble. But the way I look at it, I mean, this is going to sound really cocky. I'm trying to be Ray Kroc, so I want to raise $100 million in the next 5 years. So if I build an empire and somebody spills a hot coffee in their lap on the drive-through and I got to pay them off, I'll do it. I'm not worried about it.
The only two things the only rooms for improvement. Again, I think this is a great point, Tim, is just trying to make room for improvement. So first point would be, someone could do this themselves, technically, right? It is nice that you're pulling it and that you're adding their own exposure. The second point is that the measure of they're putting in 10% less, it gives them 20% less benefit in the end. And I'll say that in the sense of it's a 0.9 doubling. Let's just say you're doubling people's money over 5 years. So they're putting in that 10K less, but that money's also not doubling. And so, over time, the exposure there, the payment they have to make for the payment they have to make in for some investors who just do multifamily, like a lot of your Total Wealth Academy people, they're paying a bit for that protection. Now, it doesn't matter, right? It doesn't have to be mathematically 1-to-1, right? But I want to point out that there's something different about starting down and then doubling versus doubling and taking a piece out of the back end, which
if you're getting a 2x on your deal, you're going to lose 10% of that, no matter how much money you're using. And here's the beautiful thing about this. This is optional. If you don't like my numbers, don't like my program, I'm going to send you an e-sign. You decline it, you sign it. And I'm going to insist everyone investing in my deals has to take an option on this. They have to buy it or reject it, one or the other. I don't care. If you're investing in me, I don't care. But here's going to be the thing, though. Once people decline it, they're done. I mean, don't get into a deal 6 months. We get one bad, monthly report, and all of a sudden you want to go out and buy this. You don't get to go buy insurance after your house catches on fire. So you're going to be done. The other thing is no refunds. All sales are final. So if someone puts that on a deal and then a year into the deal, go, man, we're distributing like crazy. This is awesome. I don't need it anymore. I want to cancel and get my money back. No, it doesn't work like that. I'm going to be fair with people. They can't buy it later. There's no second chances. And they can't get a refund. I can't manage it like that. And obviously an operator could do the same thing. But I mean, I don't think operators are that liquid.
I meant an individual investor, right?
How would an individual do that themselves? I'm pulling it from all. You got to realize all these deals are going to be separate. So let's say I do 10 deals, 10 different multifamily deals. Everyone's going to pull their money into like this big fund. And then if one deal goes bad, the 9 that went good, I'm going to use their money to bail out the one that went bad. So it's going to be all my together. It's all mixed in a big gumbo. It's like insurance, like where you have 1,000 people paying in homeowners policies. One house burns down, and then we go rebuild their house. It's the same. It's going to work the same way.
The only thing I'll say is that the guys that I like that tried to kind of go down this route, they actually got into it and started connecting with an appraiser and then went to Lloyd's of London and were able to find a product. So as you scale this up, that might be something that could be even more bona fide. It was a guaranteed payout the way they had it, but I think there is Lloyd's of London is a complicated path to go down. But if you were to go down that path,
Yeah.
I bet you could find something that might even be easier than giving yourself the personal exposure of something happens that we don't expect, some black swan, and then you're back to zero.
But I mean, the whole thing is, if I do this myself and I control it, I don't trust insurance companies. They always tell you they're going to pay, and this happened in Wall Street in 2008, 9. There was all kind of insurance bought on products, and they screwed around with the rating agencies. They bought puts, and they didn't. I mean, they tried to manipulate it. If I'm controlling the accounts and it's FDIC, and I'm controlling it every month, here's a report, here's all the accounts, here's all the money, no money's come out, we've got money, going in. Basically, I have total control. I don't have to worry. Now, if I scaled it up, sure. But like in my little universe, I'm not going to be doing this with other people's deals. I'm really doing this to build my own business. It's going to be exclusive. And I'm hoping and praying that this is rejected by everybody as a terrible idea. So I keep it exclusive. It may not be, people may jump on it, whatever. I don't feel like I can really patent it or do exclusive, but if it gets people investing, I'm fine. If it spurs the market and people start throwing money at deals and prices start going up and cap rates start going down, then I will sit back and feel like I might have been a part of that. That's fantastic.
No, I think your timing is great. And I think you're onto something that we all wish we had, right? Especially in hindsight right now, moving forward in a rearview mirror. I think a lot of people will like this. Definitely highlight and remind people that with your whole thesis around never getting into sort of those floating rate deals, or at least as a general rule, that really adds to the concept of this being something that will be there for them personally when the time is needed, because something weird happened on a particular deal with a particular operator. I love it.
Yeah. I mean, I don't do bridge debt anyway. I'm already really careful in my underwriting. I want fixed rate debt. I want an experienced operator that's gone a couple of deal cycles. I need stuff that cash flows day one. I look for a DSCR of like 1.5 or something in that range, maybe even higher if I can get it. And I'm already doing fairly safe deals. So this is like an extra layer. And I don't really feel like the deals need it. I feel comfortable with the deals I'm done. I just think there's a lot of people out there that are scared to death or they've gotten burned. And so if it'll get more people investing, that's my whole thing, is to get people off the sidelines, because right now I think is the best opportunity, unless you can go back in a time machine to 2010.
Yep. Hey, Gabriel, the operators that that had a similar program, are they still offering that?
There was a little bit of a hiccup in their partnership, so no.
Okay.
But what they had in their unique circle that you would need if you went down the Lloyd's of London path is one of them owned an appraisal company. So they could find the right kind of deals in terms of like deals where there was built-in upside at purchase, right? Like the valuations, where there was gaps in valuation between your takedown price and the actual valuation day one, because they were able to build quite a bit of that in some growing markets. It worked, but you did have to, if you didn't have an appraisal company, you have to spend a lot of money, because the insurance companies will require a certified appraiser for that market to run the appraisal. And that's what it's all going to be based off of. So it's just something they had a unique edge around. And for theirs, they basically structured it so that it had a guaranteed, not just a guaranteed a basis, but also guaranteed payout. So it was a guaranteed the cap on the cash on cash was guaranteed for their deals.
Oh wow.
Yeah, I'm not guaranteeing that. This is just principal protection, so people will not lose their principal. And for me, it's a personal thing. I want to feel good about giving them an opportunity to protect that, and I can pay them out. And if they decline it, hopefully everything goes well. But at least I gave them that opportunity. And it may not be right for everybody. I think it might be 50-50 people will take this. And if people don't take it, here's another thing too. If I'm offering this, I think I'm in a deal that I feel like is a lot safer. Should give you a lot of confidence that I'm in a safer deal. But I'm looking at safer things anyway. I don't feel like real estate is a home run business. It's not a 3 or 4x in 5 years. If everything goes well and miracles happen, but it's really about not losing money. And if you don't lose money on deals, the home runs take care of themselves. But when you lose your principal, it's like losing your life. like a dead body. It can never do anything again. So it's like that principle. That's the most important thing. I was talking to someone at Limitless last year, and he was telling me he had a deal, a bridge debt deal, and he said everything went wrong, and he was telling me all the things wrong. And I was like, oh man, this is a horror story. And he said, and we closed it out, and we got our principal back, and I was promised an 8% preferred, and I only got like a 5% IRR. And I said, dude, you got your principal back? I mean, you need to like be just thanking God that you got your money back, and you go do another deal now. It's awesome. It's so much better than other people. So that was really funny.
Yep.
Getting his money back, and he thought it was like it was like the Hindenburg crashed or whatever. It wasn't near that bad, but it's a way of being innovative. And like my wife really challenged me, and I think it'll help my capital raising. And if people want to decline it, they can look at the legal paperwork, which isn't ready yet. By the way, I'm working with lawyers right now, putting all this together, and it's going to be a 2 or 3 page contract. And if people like it, they can take it. And if they want to decline it. It doesn't cost you anything. You got a chance.
David, the way if you build it with your retail investors, this part of this cycle, next cycle, if it's sitting there and it's an asset now, if you do what you say you're going to do, pick great deals and never use it or use very little of it, then I think you'd have an audience with a lot of family offices where you've got this asset and you can pay it forward, but with larger checks. Because ultimately, as you know, family offices want downside protection. That's like what they want to sign up for, and we can't offer it because,
yeah, that's an idea. I mean, the way I look at it is like if you're doing a fund and you're making like 15% of what you raise or whatever. Well, if this goes well, I'm making 25, and it's really mine. So I may give it to other people, but I don't know. The family office didn't come up with the idea, so maybe I'll just put it in my own bank account.
No, what I mean is you can roll it forward with a larger amount
you
already
could.
there.
I mean, you could say I've got a pool of $1 million, and if you invest this deal, I'll back up your money or whatever. But then I risk all the money that I brought into the deal. I built up on this amazing program, paying it out to one bad deal. I mean, I mean, what I'll probably do is I don't gamble. But if I ever went to Las Vegas, and I did, and I was way ahead, I walk away with all the chips. I mean, at a certain point, I'm going to be like, okay, this worked, and I'm going to pull my money out. I mean, the people that go too long are when things go bad. And so I look at this as like a 3 or 4 year program. And then after one deal cycle, if I make a lot of money, I'll probably pull it back. I won't need it. Hopefully at that point, I'll be in orbit, and I'll be able to raise as much money as I want to or need, and I won't need it anymore. I just pull it back,
Very good, David. George asked, where will the money sit, and are you planning to put into a money market account or anything like a high yield savings account?
It's going to be an FDI insured bank account. FDI insured. I already researched. One thing that sucks about business accounts for FDIC is they don't have the extended coverage. Like you can't, like you can go out and get like FDIC up to 5 million on your personal. But with business accounts, they're 250. So we're going to go with business banks with FDIC protection, 250,000 at a time. An account gets 250, and we go open another bank account. The bank accounts are going to be provided every month, full bank statement. It's going to be in the reports. Here's our bank statement. Here's what money came in. Hopefully no money went out. It will be an interest-bearing account, and the interest that is earned on the account will be mine to pull out if I choose. So I'll make money on the interest, but there's no ongoing management fees or anything like that. Right now, I think you can get about 3% on an account like that. I don't know about money markets. He said money markets specifically. I would rather just go in the FDI insured account, but it's going to be FDI insured, and the money does not get pulled out. Only 2 circumstances. We got to pay out a bad deal, or the deal went full cycle. These people put this amount of money in this deal. We closed the deal out. They got their money out. That's my money. I can take it for my personal use. And I'll probably just go and reinvest it on other deals with myself or my wife.
Right. That's really good. All right. What other questions you guys have for David?
Poke holes.
I got another question there. Is
Go ahead,
it
George.
are you personally guaranteeing this, or is there any
Well, I
guarantee
mean,
behind it?
it's I would say yes. I mean, there's just a personal guarantee. It's like a personal guarantee when you sign on a loan. That's like a personal guarantee when you have a non-recourse loan. But I'm setting this up where I feel like I can cover everything. And if it goes haywire or goes sideways more than I think, I will use my exits on other deals to pay people back. I'm gonna pay people back. I want to have a situation where people never lose money. My wife laid down the law with me and just said, I don't want people to lose money. Figure out a way to make it happen. So I will guarantee it, and I think I'll raise enough money that if more than 10% of the deals go bad, I'll still find a way to pay people restitution. You know, but I do think in this environment, if you're getting great operators with fixed rate debt, deals of cash flow day one, they're not heavy value add or heavy construction, they're not in a bad neighborhood. I just don't feel like we're going to lose more than 10% of those deals. If I thought I was going to lose 10% of my deals, I would not be in this business because I wouldn't be able to live with it, because that is an unacceptable rate of failure. I mean, I think an acceptable rate of failure might be 1 out of 30 for using fixed rate debt. I mean, when I've seen bad deals are people that have a lot of distress. Okay. I'm not saying that every deal has every bad deal has fixed rate, has bridge debt, but everyone I've ever seen, bridge debt is a common component in everyone. I haven't seen any deals that are like Fannie Mae, cash flowing day one, everything was good, and now they're losing a property. There's just not a lot of those kind of deals out there. So I feel good about it. I feel like that this is something that is going to work. And if people don't believe in the program and think it sucks, invest with me anyway and decline the coverage and just go on. It's good. You know, it's optional. It's not going to be a requirement.
Okay, so no personal guarantee.
No, I will personally guarantee it. I mean, I don't know how I sign that I'll personally guarantee it, but if it goes negative and I've got to put my own money for my exits in to pay people back, I will pay people back. I'm going to pay people back. I don't want people to lose their money. And I'm never going to be in a situation where I'm hiding from people. And there's people out there right now that are hiding gold right now because they've lost people's money.
Oh yeah, for sure. Look, I mean, I think it's a great idea. I want to see how it gets executed. I mean, I think it could be great.
Hope so. I mean, yeah, I think it'll be good, and it may not be for everyone. And I'm going to be really careful about my operators, really careful about the deals on certain principles. I'm going to do a little bit more due diligence. I'm going to ask a few more questions of my operators. And if people get into the deals and they don't want to take part in, they don't want to participate, it's going to be optional. So it isn't going to matter. You know,
Yeah, 100%. I was going to mention that. I mean, it's all going to come down to the operators you pick. And I mean, I have seen some of those deals where it is a fixed rate loan and there's still issues. You've also got, if an operator has an issue on other deals, that could transfer over to a deal with a fixed rate.
100%. I just bought one in San Antonio. There's an operator that got in trouble and they lost 8 deals from a bank, and we just bought one of them. So I know that. Also, though, I feel like the market cycle right now in 2025, we're in a totally different place than 2021. I feel like we're near the bottom of a market cycle. So I think this is a better time to do this. And when the market is frothy and hot again in 2028 or 29, I probably will dial this back. I'm probably going to go through one deal cycle through this. So if you want to do it, also there's another thing too. If I get the one deal cycle, I raise a lot of money, I'll have investor trust by that point. I won't need it. And if I don't need it, I probably won't have to use it. But right now I think it's a tool. It's being creative. I'm going to put it out there. I'm being innovative. And it's going to be different for some people, and being innovative. I think it's the most innovative thing right now in capital raising that I've heard of. I don't know of anything else other than Tim's marketing with AI models that are perfect, you know, that talk in 24 hours a day, you know. But I'm not a big tech guy. I'm really a numbers guy. So this is a program based on numbers, and we're gonna kind of turn the tables on the way that this works, and we're gonna basically take some smart bets.
Okay.
Yeah.
Wish you luck on it, man.
Thank you.
Yep. All right, John, go ahead.
Yeah, hi, David. I was curious if you've thought about how your program might interact with the program I have currently on my offering, which is a Reg CF. It's called Tiger Mark. It's issued by a company called Assurity, or Surely, I believe it is. And it's basically protecting my investors from mismanagement, misstatements, frauds, activity, and that sort of thing. Have you thought through, or are you familiar with that type of policy I already have in place?
No, it sounds like an error in emissions or some type of fraud protection. But I mean, the thing is, the way I look at it, like when you lose, the thing is, I don't want to deal with insurance companies. Here's the thing. I don't trust insurance companies. They bring in tons of premiums, And then when it comes time to pay out, you can't pay out. I'll give you an example. My mother's 81 years old, lives in a 30-year-old house, has a 15-year-old roof. And I was helping her get her insurance renewed a couple months ago. And her insurance agent was saying, look, we'll cover your house, but your roof is old. We won't cover your roof in Houston. Well, if you're not going to cover the roof in Houston, we have hurricanes. I mean, insurance is useless. So I don't trust insurance companies. And like George was talking about, if I want to get in really big trouble in this program, if I get beholden to an insurance company, I'm expecting them to pay people back, I'm going to be in big trouble if they default. And insurance companies, they are the weaseliest people of all time. I just rather have control of the money, have it where it's there, and then pay people back. And if I have the resources to pay people back immediately, I will do it. And I will ask of two things when I pay people back. I'll ask that, number one, they do a testimonial on Zoom and explain how the program worked and I paid them. And I will also ask that they take the money I gave them back and invest in another deal. And that second one is definitely going to be optional. But I've got the whole deal cycle to pay people back. But yeah, I don't want to go and scale this up. I don't want to get involved in insurance companies or hedging. I might talk to some wealthy family offices about going in and doing some hedging with them if I feel like I need it. But I'd rather work privately with people than go out and work with an insurance company and then explain to people, well, I really want to pay you back, but I worked with this insurance company and now they don't want to pay. I can't be beholden to insurance companies. I just don't trust insurance companies. They're just.
Let me add something here because I'm an insurance guy my entire adult life, and I'm 67. You're referring to property and casualty. You're referring to property and casualty companies, and it continues to be a battle. I'm in the annuity and life side, and those are strong contracts that are backed up by A-rated companies, and they tend to do everything it says in the contract. The problem is people not understanding the contract.
Yeah, but I don't want an insurance company to tell me later I didn't understand the contract, and that's the big problem there. They always, that's the thing, you didn't understand the contract you were signing. I just want to keep control. I don't want to play the numbers. I'm going to keep the money in FDI assured accounts, and then if something goes bad, I'm going to pay people back either immediately or at the end of the deal cycle, depending on market conditions and how much money we have in the account. And I'm going to maintain control over it. If I find a way to hedge it smartly, I might do that, but that would be a later on thing if I really scale it up. And I don't think this is going to run long enough to run into that. I'm not trying to start an innovative insurance company, and I'm sure as hell not going to cover other people's deals. I might cover other fundraisers if they were in the same deal. So let's say we had a really big deal and we got to raise $50 million, and we have 4 or 5 really good superstar fund managers, people that work with Tim. And they said, hey, could you offer this to my people to help me raise more money? I might do that because I already believe in the deal. But I mean, I might limit my exposure, say, look, I'll segment off this much. It's all going to be about risk management. And I'm not looking at scaling this up because I think if you get too much pride, then you have a fall. And I want to keep total control over it. So I'm not beholden to anybody else. And doing an insurance company thing, like even Lloyd's of London really scares me because I don't believe that they'll pay when they need to. I learned that in the financial crisis. Watch The Big Short when they were supposed to pay out to Michael Burry, and they tried to screw him. They had all these contracts written out that were going to pay him, and they tried to screw him on it. And they waited, and it's all. I mean, they think they have easy money. And then when it's time to pay out, they don't want to pay. So I don't trust it.
Yep. All right, David. Let's wrap up this part of our interview. So for those that want to reach out to you, connect with you, what's the best way to reach out to you? I know we're going to put the link to your webinar in the chat here, but also give it verbally for the people that are listening to this on podcast later. What's the best way to get a hold of you?
The best way to find me is always LinkedIn. I'm trying to be on LinkedIn. My goal right now is to be on LinkedIn more than I'm on Facebook, and I'm working on that. But LinkedIn, David R. Priest, you can get all my contact information there. And then you can also book a call with me directly. So if you want to book a call, that's the easiest way. And if you're trying to catch me, that's the easiest way to catch me.
Excellent, David. Thank you so much. All right. Well, David, really appreciate you for coming on to our show today. I love what you're doing with this principal protection program. Look forward to see the implementation of that and the rollout of that. And so thank you so much for being on with us today.
Thank you.
Okay. All right, guys, let's take a group picture with David real quick before I put you guys into your breakout sessions. So turn on your cameras. We're gonna do a group picture real quick. Okay. Yes. All right. You know our pose, right, David? I don't need to share with you. Yes, right, baby. Are you guys ready? 3, 2, 1. Yay. All right.